So will 2024 be the year that the commercial real estate market pretty much collapses and implodes? That and much more on today's video. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy here putting the realism back into real estate. Hope you're doing well. Happy New Year to everybody. I hope everyone had a great time off with family and friends, enjoyed the holiday, little recharging, etc. 2024 is going to be a little bit of chaos, very turbulent for the residential housing market, and it's going to be chaos for the commercial deals. So let's get into it right now. So I thought this was interesting. New York City and San Fran dominate the U.S. cities with the heaviest commercial real estate office debt loads. All right, so big time stuff here. When you take a look at high interest rates and the slow return to the commercial real estate sector, office towers, etc., you're going to see a lot of declines happening. All right, so we basically have, if you're an office tower owner, you're going to be repaying the full value of the loan, or finding somebody who will do a refinance for you. Now, the issue we're going to have with the refinancing is a lot of these regional banks are taking a bath, okay, on what's going on in the industry. So the position is that people who have loans coming due are going to be in a situation where, hey, the balloon's being called. What are you going to do with the property? Can you afford it? These resetting of rates, like it's going to be chaos out there. We'll see a lot of carnage, etc. So according to a new report by the Financial Times and the Mortgage Bankers Association, $117 billion in commercial real estate office debt needs to be repaid or refinanced this year. Much of the debt is concentrated in Manhattan, San Fran, Chicago, LA, major type cities, all right? So again, not surprising when we had the pandemic, what happened? A lot of people actually left to work at home. You had, the office towers kind of sitting vacant or significantly vacant. Now people working from home, different lifestyle choices, etc. They don't want to return. There's a lot of things going on out there in the marketplace, right? So we're going to see how this plays out this year. There's going to be people that are going to get hurt, or buildings that are going to be vacant, or lenders are going to be left holding the bag on the stuff, right? So current trust balance for commercial mortgage-backed securities up for refinancing in 2024. This gives you a breakdown by city. So New York, Manhattan and New York, obviously, San Fran, Chicago, LA, Houston, Long Island City, New York, Sunnyvale, California, Burbank, California, Philadelphia, Pennsylvania, Santa Clara, California. So obviously Manhattan leads the way with all the stuff that's coming due. It's significantly populated, significantly dense situation with high rises and offices, etc. But you take a look at California, we got San Fran, LA, Sunnyvale, Burbank. You got five of these locations here that are leading the way with respect to, the deals that are, or mortgages that are up for refinancing during this year. So can that be absorbed? Will there be lenders for all this? It's going to be kind of dicey as time goes on. But that's part of the whole real estate game here. Commercial does have its risks. It's riskier than, obviously residential real estate. And a lot of it is based on, the timing of things, right? A lot of these loans were either refinanced or buildings were constructed or put into play during the quantitative easing time frame when there was opportunity and rates were exceptionally low. Fast forward to today, rates are higher. The Fed has reset the rates over the past year and a bit. It's much more expensive right now. If things are coming due, what are you going to do if you own one of these office towers? Now, we've heard, not just through the grapevine, but we've actually seen it in print here on the internet, that there are hedge funds and there are companies that are basically saying, we're moving, we're relocating, or they're literally giving the keys back to the lender saying, we're not going to refi, we'll take our lumps, we don't want this anymore. In the end, it's just better to, I guess they're looking at going, it's better just to remove the problem as opposed to keep paying for it or trying to refi or getting into litigation scenarios. So this is what's going on in the commercial world. It's really, I think right now with the larger cities, it's going to be office type properties, but we've seen hotels, strip malls, things like that hit as well. In our area where I live locally, in the Tampa, Florida area, we do see a lot of sort of like smaller office complexes or strip mall areas that are having a hard time with refinancing and things like that. So obviously you need a good tenant base. You got to have decent leases to support this. Property taxes are up, operating costs are up, labor costs are up. Like electrical, like utility costs are up. So you can see that these office complexes they're getting squeezed. Is there any margin there left for the ownership? Who knows, right? So this is very interesting, as they're saying, difficult environment to getting loans from these institutions that give these loans. That's the bottom line. Basically, you already had banks that collapsed. Silicon Valley Bank, First Republic, Signature Bank. Okay, those are small. No, I don't call them small banks. They're banks that are probably more apt to lend to these commercial properties. Regional banks, a lot of the market, a lot of the loans are currently held by regional banks and community banks. And guess what? They're going to take a pounding on this. What's going to happen to those banks? Who knows? It puts more banks into that area where they're in high risk mode here. So Moody's Analytics estimates about 605 office towers with mortgages will need financing this year. Of that, about 224 will have trouble refinancing. So there's already, basically we're looking at already more than a third will have trouble refinancing because the property values have plunged and there's too much debt or high vacancy rate. So that's the situation. So, hey, it was great when you first started with this building, and you constructed it, or you purchased it, you refurbed it, you had it all leased up, but now things are changing. Values are dropping. Your loan to value is not going to work. Rates are going to go up. I mean, what's there to do except just possibly walk away? So it will be difficult for the commercial sector big time this year. And this is just for we've already had some stuff happen in 2023. This is just scheduled for 2024, and it still goes on to 2025. I think overall, the next, last year, the next maybe 2 or 3 years going forward, the total value of loans in commercial that are coming due need to be refunded was about 2.5 trillion. It's a lot of money. It's a lot of loans out there. It's going to affect a lot of people and a lot of locations. And again, we'll have to see how it plays out. It's going to be a little bit of chaos for sure as time goes on this year. So, and folks, by the way, if you appreciate the information I provide, if you could do me the great honor and hit that subscribe button, that would be wonderful. Thank you very much. And if you're a current subscriber, or think you are, if you could please reaffirm, hit the subscribe button again, hit the bell notifications, because you know what? I tend to lose subscribers every day. And that's the way it goes on this channel. All right. So, interesting. This is out of the same article here. U.S. cities with the most loans up for finance. So if we go into cities, we've got Manhattan, Houston, L.A., San Fran, Sunnyvale. I mean, you can look at the list here all the way down to Washington, right? So essentially, you've got states or location with certain office towers. You got cities that are, that obviously are taking the brunt of this. So, again, Manhattan, Houston, L.A., San Fran. That was, Sunnyvale. That's your sort of big hitters right now. So. There will be problems out here. People are leaving certain states. People are moving out of Manhattan and New York. People are leaving, California. So does that contribute to lack of workers that would occupy these buildings? Who knows? I know a lot of, we'll call it, corporations have relocated out of places like New York City and out of California for cheaper accommodations for their employees, different tax bases, different, better social and political climates, et cetera, from their perspective. So, things are changing. And in the end, it's like these are structures that are sitting out there. Now, I can tell you that a lot of the thought process is, well, we'll take these empty office towers and we'll convert them to residents, right? We'll make them condos or something. Well, that's great. I mean, that's probably what you'd want to do and probably need to do, but that doesn't come out and happen overnight. So there's still going to be carnage along the way. And again, it's it's not just the fact that you can do that. This is the different zoning. The cities or the counties have to be on board with this. Someone has to finance all that. It's not like if you have a 10 or 15-story office tower, you're going to convert into condos or apartment style residences. You'll think of the reworking you're going to have to do. Okay, you're going to need to put plumbing and bathrooms, and electrical, and all these smaller suites. So it's not like we can just change some floor plans and put some drywall in. It's a complete refurbishing of these type of buildings. So that's not easy. It's going to take a lot of cash and probably take a lot of time. So not sure if that can really help. So essentially, when we take a look at where it's at here, when we're looking at, delinquent type loans, you can see that's been a big increase, from where it was back last year. So we're up to almost 6% here, 6% as opposed to, 1.7 and change. So that's different, okay? 40% of the office loans on bank balance sheets were valued less than the loan, amount. So you've got a lot of contributing factors that are going to put a lot of stress on the regional banks, other banks as well too. Again, going back to the fact that when you take a look at the office towers that need financing, and some of them they're already saying are going to have trouble. We're already laying the groundwork for a bad scenario. So again, can it get much worse? I don't know. We'll have to figure this out throughout the year. What will most likely happen? I mean, banks will take a hit, maybe they'll extend payment terms, maybe they'll do some workouts, etc. Depending on the location, depending on the size of the loan, and can they resell this or can they get new tenants, etc. So again, banks are not in the business of owning real estate and property managing their assets like this, right? They need buyers. They want to get it off their books. They're not real estate companies. That's part of the banking guidelines and codes. So it will be very interesting to see how this all plays out. So again, just laying the groundwork. Is there a domino effect here? Of course, there's going to be a domino effect, right? This is a result of a domino effect that we've seen with taxes and cost of living, etc. People leaving the bigger cities, going to tier 2 and tier 3 locations, or going to different states with cheaper economics so they can make ends meet, whether it's from the business side of the corporation or from the personal side. So it is a big change, and we're seeing a lot of shift in things that are going on in both the commercial and the retail housing space here. So that's a scoop. So getting back to, hey, kicking off a new year, what am I looking for? Hey, looking for investor buyers, cash buyers who need single family homes, private funding partners. We have a lot of great ideas and great things we're doing right now for our projects. Looking to recruit real estate agents. We're starting our campaigns now, and I can tell you that we really have done a lot of data mining and diving into some great opportunities for this 2024 with respect to the distressed property market. I'm looking for joint venture partners, our real estate investors, to bring your distressed deals, bring them to us so we can look at them and review them and see if we can participate or we can actually help you get them taken care of. So that's what's on the table right now. So clearly, you've seen this before, the top 10 ways to earn income and build wealth during the housing correction, housing crash. This is the stuff that we're actually involved with, but I've actually amended it. So no more top 10 ways. We've got top 12 ways. So I'm adding code violations and adding what's called this concept called novations or retail buying. Okay, a little different, we'll call it flavor to straight wholesaling property. So all the things that you see on the list is that we are touching or participating or know what we're doing, okay? So it's just a matter of cranking through these opportunities. There's a lot going on out there, a lot under the radar, and that I think is the best thing. So everyone is looking at you look at Zillow, you look at homes.com, you look at realtor.com, and everyone's looking at on-market properties to purchase. Well, that's the problem. Anything that's on the MLS, it's not moving, or you're paying premium, or you've got to factor in other things to go along with it. The opportunities are in this methodology list here of how to participate in the field. And who is this for? Well, it's for real estate agents who want to who are not making ends meet, because let's face it, it's tougher now, right? We know that there is less sales activity on a monthly basis going on, so agents have to, what are you going to do, right? You got to find other ways to get clients or to list properties or to put deals together. So this is all possible. That's what I do. Also for real estate investors, we don't want to purchase a property at retail off the MLS and then fix and flip it, and you're stuck with, holding, high debt property you can't sell, and the rents aren't making ends meet at the end after you've fixed and flipped it or tried to flip it. So this is where you get cheaper type properties. And for people who I want to live in a property, I want to be I'm a primary home buyer. Okay, I just want a cheaper property. We've seen the past year and a half that more people are flocking to the investor side to learn investor concepts and focus on investor concepts to acquire property that's a little better priced, so it's easier for the homeowners to make ends meet, or to second home, to start to build wealth, whatever. So I'm seeing a lot of that right now. A lot more people, for example, are going to the foreclosure auction, are paying cash at the foreclosure auction for properties because they believe, they may or may not at the time, but they believe they're getting better deals than retail buying. So that's what's happening. So we're seeing a shift in where the world's kind of going. It's kind of becoming this sort of blurry gray area as to where you want to participate. So again, we can help you with all that. So ultimately, in the end, this is the deal. All right. Connect with me if you want. There's my email. You can drop me a line. We'll talk about things. But 2024 is going to be a very, very busy year. We've got a lot of stuff that we're doing. I've got a whole list of data that we're parsing through right now, and we're making calls starting next week to homeowners and really starting to pick up the marketing, because it's all sitting there waiting for us. It's all under the radar. That's the best way to pick up properties on the cheap. All right. So again, getting back to things, right? Are we having a housing crash? Who knows, right? I think we're over that right now. Do we have a housing bubble? Yes. Do we have an affordability crisis? Yes. Are we having a crash? I don't know. All right. Everything is managed. So the market is completely manipulated and managed. The whole key, though, is to sort of find your ways in between the seams to figure stuff out. And that way you can earn income and build wealth in this crazy real estate sector. So anyway, guys, I appreciate the views, likes, and the comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. I look forward to speaking with you in a couple of days. Take care.